Good evening, everyone. We have over 125 registrants. I'm just watching the attendees clicking in, about 37 so far, but we're going to go ahead and get started with some housekeeping logistics. Welcome to our pre and post retirement planning seminar. Alex and I are thrilled to be able to present to you. This is one of our favorite topics. For those of you that are interested, this is being recorded. So if you are interested in a recording later on, we do post it on our website, I believe also on the internet. And we will be sending out copies of slides to all of the registered attendees probably in the next week or so. In addition, if you happen to be interested in continuing education credits, there will be 4 polling questions throughout the hour, and you have to answer 3 out of 4 in order to get credit. We do have the chat box open. Just want to make sure I can see it, Alex can see it.
That's right.
We received over 40 questions or so just from the registration process. And we are, going to try to make sure we leave time at the end to address your questions. But if you have any new questions that come up as we go through, leave them in the chat box. And if we can't address them at the end of the webinar, we will certainly try to get back to you. Okay, so we don't have our director of marketing to present us, so it's going to be me. Why don't you go back one, Alex, for a second, to our pictures. There you go. All right, I'm Judy Barnhard and Alex Seleznev here. We're both partners at CBM and also co-founders of May Barnhard Investments. And you'll see we're both certified financial planners. Alex is also a chartered financial analyst, which means his specialization is going to be more on the investment side. And I'm a CPA, and my specialization is going to be more on the tax side. So we're a good tag team. We like to present together because we kind of got it all covered, we hope. And what we don't, we'll certainly get back to you on. Next slide, please. Just a little bit about us. CBM is a regional full-service accounting firm specializing in audit and tax services. And in 2018, it acquired May Barnhard Investments, which otherwise known as MBI, of which, as I said, we are co-founders of and also officers in. And MBI provides comprehensive financial planning, investment management, obviously retirement planning, and financial consulting. We are registered investment advisors with the Security and Exchange Commission, meaning that we also adhere to the regulation BI, which is best interests, such that we are always providing advice in the best interest of our clients. We're fee only, and so we don't receive any kind of compensation from product sales or commissions or anything. So you'll know that you're getting independent and trusted advice from Alex and Judy. Next slide, please. Learning objectives. We're going to hope to give you a better understanding about financial decision making as you prepare for retirement. We're going to be discussing estate planning to a little bit, Roth conversion, certainly, cash flow and debt management, Social Security, and other consideration in terms of retirement planning. And Alex is also going to share with you some protection strategies for investment portfolios, how to experience market turbulence, which we are certainly all experiencing right now, gifting and some wealth transfer strategies. Topics that would be covered is shown on the next slide, Alex. And of course, our goal is really to help you prepare for retirement. We want you to make wise and financially sound decisions, and we want to give you the tools to be able to start thinking about that. And next, Alex is going to start off with some retirement planning.
Sounds good. Yeah, thank you, Judy. And again, thanks everyone for joining us today. So we'll start with your overall retirement or financial plan. And I actually tend to use the words interchangeably, even though in some cases they actually tend to mean different things. But in the context of our webinar today, it's really more or less the same thing. So I'll also start by saying that we're certainly biased. We believe that everyone should have a plan in place, and especially those of our clients who are either thinking about retirement in 3, 5, 7 years, or specifically those who are already in retirement or perhaps partially retired. Now, a comprehensive financial plan doesn't have to be a long 57-page document. It can actually neatly fit on a 1 or 2 pieces of paper, but everyone really needs to have one. Now, assuming that you do have a plan in place, usually the next question is, well, how secure this plan really is? And the answer to that question depends on how clear of an understanding you have of your income and expenses in retirement. What about your Social Security income, pension income, if you're partially employed, if you're working part-time? What about your expenses, current expenses and projected expenses in the future? Do you understand what that would look like? Now, there are many popular rules of thumb, or essentially shortcuts, that we tend to use in our client conversations, especially in initial meetings, but they actually may not be appropriate, and in some cases even dangerous for long-term planning. Perhaps one of the most popular one, and I have a feeling many people are familiar, at least heard about it, is the 4% distribution rate rule. And essentially, the way it works, let's say you're 65 years old, you're going to be in retirement for the next 30 years. Let's just make that assumption. You have $1 million portfolio. So how much can you safely distribute to yourself? So if you apply this rule, the answer to that question is $40,000 per year, and then you would adjust it for inflation each year. And then again, presumably, you're not going to run out of money by the time you're 95 years old. Now, there's a lot of research behind this model, so it actually works, at least statistically speaking. In practice, perhaps not so much. I don't necessarily have to go far. If you go back to 2020, the pandemic year, and I'm not necessarily trying to remind people about it, but when the markets are down by 20, 30+%, how comfortable are you going to be with, distributing 4% out of your portfolio? What about this year, 2022, when the market's, quite volatile, to say the least? Is this a comfortable approach for you? In terms of more, tactical issues, for many of our clients, they have their taxable portfolios, they have their tax deferred accounts, such as IRA or 401k. So exactly how much do you draw from each account? Should it be 4%? From all different types, or should you actually partition it somehow? So lots of issues with that rule. Now, the other one is perhaps less familiar, but also popular, is when you take 100 and you subtract your age. Let's say you're 60 years old, and then the difference is supposed to be your allocation to stocks. So, let's say 100 minus 60 gives you 40. So, 40 should be your allocation to equities. Now, this rule is very simple, but essentially has no basis behind it. It's just one of those things when people really try to simplify it and they come up with rules like that. There are many online, and let's just call them do-it-yourself calculators, Excel spreadsheets that you can find all over the internet. Many 401k providers actually they give you this useful tools, I would say, to ballpark what you should expect to have in retirement. Let's say you're 40 years old and you're thinking about retiring in 20 years, at your current level of savings, what would it look like? But again, for long-term planning, that is not likely to be adequate because it doesn't give you that level of detail that you really need. So a better way of answering this question is to have a retirement projection that is designed for your specific circumstances, and very important, that is designed for your specific tax situation, because there's going to be a huge difference for someone who is retiring, and let's say in the lower tax bracket, versus someone who is retiring and perhaps in the middle or higher tax brackets. There are two ways of doing it, and perhaps there are different names that people use. There's the so-called top-down approach, which is essentially where you start with everything you have. your bank accounts, your investment accounts, IRA, 401k, all of that. You make some assumptions in terms of your projected rate of return, in terms of future inflation, which is also not always easy. Of course, you include your Social Security income, if you have any pension income or any other type of income, and then you solve for how much you would have, let's say, from your age 65 to, let's say, age 95. Now, once you have that figure, again, you have to tax affect it. That is very important. And then essentially compare that to your either current or future expenses. That should give you a very good idea if you're on track or if you actually need to make adjustments to your overall plan before you actually retire. The bottom-up approach will usually lead you to more or less the same conclusion, but it's a different approach, meaning you start with what you actually want to have. So let's say I want to retire and have $7,000 for the rest of my life. How much more do I need to save over the next number of years to accomplish that goal? Or what should be my starting point? So it's similar, but essentially you approach it differently. Now, what is also important, again, 2022 is a perfect example of that, is once you come up with a scenario that makes sense for you, you need to stress test it. What would happen if in the year of your retirement, your portfolio is down by 20 or 30%? Exactly how will that impact your cash flow? Exactly what protection mechanisms you have in place so that, again, you can essentially maintain your lifestyle. That is very important. So talking about different portfolio protection mechanisms here. So one of the perhaps most important things that people know about, but very frequently don't necessarily spend that much time to truly understand is your overall asset allocation, your overall investment mix. There are lots of studies on the subject indicating that up to 90% of your long-term performance results can be explained by your overall asset allocation. Again, essentially the split between your stocks and bonds. So how diversified you are. And I would say most people would agree that you shouldn't be putting all of your eggs in one basket, right? Now, what happens in practice, especially when we work with new clients, let's say they have 5 accounts. Let's say the wife has 3 accounts and the husband has 2 accounts, different brokerage houses. Now, the funds are invested in different options. Let's say they're mutual funds or exchange traded funds, but in many cases they cover essentially the same types of stocks or bonds, let's say large cap stocks and let's say intermediate term bonds. So then when the markets are down, again, I don't have to go far, like what we've been experiencing this year, people are surprised why their accounts are down by more or less the same percentage across the board. Well, the answer to that question is, you have a lot of funds, but it's not really a diversified portfolio. Now, considering your risk appetite in the context of your expected longevity, that is very important. For many people, assessing their risk tolerance or risk appetite is usually a relatively straightforward exercise. You ask some questions, you have a conversation, and usually you come to that conclusion. Now, in terms of your longevity, how exactly would you assess that? Do you have a history of longevity in your family? That's one of the questions we like to ask. So what's important here, and again, this is particularly important for young retirees, people in their, let's say, late 60s, early 70s, is to ensure that they're not investing too conservatively, meaning that they actually impact the likelihood that they're going to outlive their money over the next 20 to 30 years. Age and inheritance considerations are important factors, especially for some people, meaning if it's important for you to leave a certain amount for the next generation, or actually the opposite of that. In some cases, we work with clients who expect to receive a sizable inheritance, and perhaps, well, in many cases, actually, it should be incorporated in their plan. So what we discovered, and this is actually how we operate, how we manage money, we based most of these decisions on the actual cash flow that we expect these clients to have. And I will give you an example in just a moment of how that works. Now, in terms of the portfolio protection mechanisms, again, not putting all of your eggs in one basket and making sure that you understand what is actually behind the funds you have will likely have a lot of impact in the long run. So if you look at this conservative portfolio here that consists of only 20% in stocks, well, essentially over the past or is it 80 years or so, it returned close to 6%, which is not bad. But if you look at a growth-oriented portfolio, which is on the right side here, it actually returned close to 9%. That is much more in the long run. And again, when we're planning for the next 20 to 30 years, that makes a huge difference. In many cases, we're talking not just, tens of thousands, perhaps even hundreds of thousands. So there is that opportunity cost of investing too conservatively, again, when you're in that young retiree group. Asset class returns quilt. For those of you who participate in our quarterly market updates, this is where I usually spend a lot of time discussing how different asset classes, performed in any particular quarter. The only reason I'm showing you this today is so that you see how differently different asset classes perform. Large caps, mid caps, real estate, international stocks. Look at international, emerging markets specifically. We highlighted that in the red. They either on top or on the bottom for most of the years. Commodities, something that's been performing really well over the past couple of years, usually on the bottom. So that's something also to keep in mind. So again, there's that value of diversification. So our cash flow based approach. Here's I'm going to say a simplified example. In practice, we do have to add a few more variables here. Let's say we work with a client who has, $800,000 available for retirement. We had, multiple meetings with her, and we determined that she needs to have $7,000 per month, net of taxes, adjusted for inflation, to maintain her lifestyle in retirement. Now, let's say this is a former government employee. She has her pension and also Social Security income, net of taxes that covers $3,000 of her expenses. So there's already that annuity in place. There's already that protection mechanism in place. Now, she needs $4,000 from her portfolio, again, for life to maintain her lifestyle. Once we determine that, we would annualize this figure, multiplied by 12 essentially, would then multiply it by 7. I'll explain why in just a moment. And that gives us $336,000 that needs to be in bonds. And when I say bonds, what I really mean, cash-like investments, certificates of deposit, money market accounts, a variety of different fixed income investments that are safe and liquid, at least in most market environments. The reason it's 7 years, by the way, without giving you too much theory, but that's the average business cycle in the United States. So by covering our clients for 7 years, covering their cash flows for 7 years, we're ensuring that we're not going to be in a position where we need to sell stocks, again, when the markets are down, to supplement for their cash needs. We're creating that buffer. So 336,000 divided by 800 gives me 42%, and that would be our suggested allocation to bonds. Doesn't necessarily mean that that's the investment policy we'll propose. Well, not necessarily. We'll have a conversation. We'll adjust it for the market conditions, adjust for the actual, risk preferences. Perhaps it needs to be lower, perhaps it needs to be higher, but this is an objective way of doing it. We're not using any rules of thumb here. We're not just making some broad assumptions such as, if you're older, you should be investing more conservatively. We're actually doing it based on this client's specific needs. Judy?
I think Marissa's going to launch a poll here. And there it is. Are you still here?
So I'll respond as well.
I'll let people respond. And Alex, you want to proceed to the next page? Okay. So we're going to talk about cash flow and debt management. And I first wanted to just talk about debt. It's pretty shocking, really. I was reading a Forbes article, and it says 61% of households headed by seniors aged 65 and older have debt. So that's quite a large percentage of the population. And according to Experian, which is one of the credit agencies, an average 69-year-old consumers have the highest personal loan balance of $20,000. That's the average balance. Now, I'm guessing that's probably automobile loan, but it could also be credit card debt. So, a prudent financial, theory is that seniors really shouldn't be taking debt into retirement, and they don't really need to be having yet another monkey on their back, if you will, when they're going to be living on kind of a fixed budget. And I think just sound theory is that, it forces then reasonable spending in your pre-retirement years and following, a good household budget so that you're managing your debt. Now, what do you do if you do have debt, which, according to Forbes, 61% of the households do? Well, when we ask for, an inventory of clients' assets and liabilities in preparing tax projections, we look at the debt and we rank them really based on, what type of debt it is. Is it mortgage? Is it a car? Is it, credit card, consumer debt? Student loan debt, which hopefully people going into retirement don't have that, but some might. They might have taken on some for their children. So rank them by the interest rate associated with the debt, right? Bankrate.com right now is saying that the average credit card debt interest rate on credit card debt is 19.04%. And for automobile loans, of course, in this higher inflationary and interest rate environment, automobile loans now are 5 to 6%, where the old days of 0 or 0.0 is kind of gone. So you have to factor that in as you're planning on retirement or in retirement, that you really try to delay, frankly, if you are carrying consumer debt that has high interest rates, go ahead and tackle that now and get that off, and you'll find that it's going to be much better for you, more comfortable, and you'll sleep better at night about your retirement. Another question we get often is about mortgage. Should you pay it off? And we get this all the time. There's a lot of factors involved, specifically what the interest rate is, what the balance left on the mortgage is, whether or not the individual happens to itemize or not itemize on their tax returns. And I'll just a quick example here. If a potential retiree bought a house at age 45, 30-year mortgage of $450,000 at 3%, and retires at 67 with $1 million nest egg, should they, take the remaining balance of the mortgage and pay it off with their nest egg, or should they go ahead and just continue the payments until it's done? Now, obviously, the difference is that if they left it in their nest egg, that would be growing, right? It would be growing in this particular rate. Assumption is at 5%. And, you just see here, there really actually is no difference given this specific scenario. But as I mentioned, it really is a facts and circumstances for each individual taxpayer that has, as I mentioned, all the different factors. So I would say you don't want to, just willy-nilly decide to do it. We've seen, unfortunately, on the tax side, people just say, well, I just took money out of my retirement and paid off my mortgage, and they didn't understand that the retirement is going to be taxed at ordinary income. And if they were earlier than 59 and a half years old, there's a 10% penalty. And then all of a sudden, like, what? They owe a big tax bill. So definitely want to seek counsel before you decide to do that. You can also, just in terms of cash flow, I did want to mention that many retirees may want to have access to a line of credit, a home equity line of credit. Not that you necessarily want to maintain a balance on it, but if you have it there in case of an emergency before you retire, it's easier to get one set up. And there's also, retirees sometimes have the ability to tap the cash value buildup in life insurance policies. So that might be one way to pay off some of the consumer debt that's at high interest rates. And of course, many of the credit card companies send these kind of teaser rates that if you transfer the debt from one card to another they'll offer you a lower teeter rate for a period of time. So there are mechanisms to try to get the consumer debt paid off. I just would be careful about some of these credit consolidation companies that might call you. Just make sure you know all full disclosure before you enter into any of those transactions. Next page, please. Okay. Another question we get is should you have a 30-year mortgage or a 15-year mortgage? Right now, the 30-year mortgage interest rate is running at about 7.2%, and the 15-year mortgage rate is at 6.24, so about 1% less on a 15-year. In this example, you'll see a $500,000 mortgage at an interest rate of 4.5%. The difference between a 30-year mortgage and a 15-year mortgage, the payment difference per month is only $1,292. Okay, so you're going to pay more for a 15-year mortgage because the amortization period is shorter, right? Even though the interest rate's lower, you're still going to be paying more per month. But look at the next column in total interest paid. You're going to be paying $223,000 more in interest, and many borrowers, of course you never see it, right? You sign a promissory note when you get your mortgage, but you're like looking at this number and saying, wow, I could have saved $223,000 if I had just kind of, tightened the notch on the belt and gone to a 15-year mortgage. So that is a significant savings. Right now, with the interest rate environment as it is, if you have a 30-year mortgage, it's unlikely you're going to want to refinance to a 15-year because it's going to be at an unfavorable rate. So you can also achieve this kind of similar savings by simply doubling up on your mortgage payment, the principal payment for the next month. So what you're doing in essence is you're truncating the amortization period. You're bringing it shorter in, and thereby paying down the principal and getting that savings of the overall interest paid. And the other thing to keep in mind is that if you do have a 30-year mortgage and you do make these payments, it gives you the flexibility, right? So if one month it's Christmas time and you want to use that money to pay for Christmas presents, you could just skip that month, and then starting in January, start paying down the next month's principal again. So it gives you a little more flexibility on the 30-year mortgage. The other thing I just want to say is you have to consider what the opportunity cost of the $1,292 savings is. Like if you had a 15-year mortgage versus the 30-year, what would you do with it difference? Would you save it or would you spend it? So those come into factor into this decision. Next slide, please. Spending habits. So there's always the question about, what do you think you'll actually be spending when you're in retirement? And this is a breakdown prepared by the U.S. Bureau of Labor Statistics. It is from 2021. And you'll see housing is the biggest cost. It's 35%. Sorry, it's yellow and it's down on the bottom. But housing consists basically of rent and mortgage payments, but it also includes home insurance, repairs and maintenance, housekeeping. It's kind of an overall catch for all of the costs of maintaining a house. And that's going to be your largest cost in retirement. The next two largest costs are healthcare and transportation. And healthcare, of course, is going to be, your insurance premiums, but also prescription drug costs, other out-of-pocket costs for medical care and supplies. And the travel is going to be both, just local and transportation, maybe for travel to see family and so forth. And that certainly has got some discretionary involvement to it. But this just kind of gives you an idea as to how your dollars will be spent in retirement. Next slide, please. This also just reflects what you can expect that will change between pre-retirement spending and retirement spending. Also from the U.S. Bureau of Labor Statistics, I think the rule of thumb is that you can expect roughly to spend 70 to 80% of your pre-retirement expenses in retirement. So you will be spending less, but not 50% less. It's more like, I would say, financial advisors are probably saying 20% less. And you can see here where it is. It's, you know, it's all across the board in terms of, you know, transportation, apparel, you know, insurance, education, personal care, food, all the way down the line. And interestingly enough, healthcare, of course, is higher, right, by 15% contributions, but that's discretionary. You can expect it will be higher in retirement. And reading, I like that. Reading will be higher. Next slide, please. So this is the most important, I think, takeaway, at least from this part of our presentation. And this is what the exercise we would do when we prepare retirement projections for clients is you first have to sit down and do a budget. And I will say you've got to be honest, err on the conservative side. You know, it's human nature to kind of say, oh, I won't spend that much on, you know, restaurant meals and whatnot. But you really, if you go back and you actually look at your spending, your current spending, you know, scour your checkbook and your credit card bills and see how much you're spending at Amazon and, you know, really get a good feel of what you're spending and break it out by category. Some clients even actually use, you know, some automated accounting systems to keep track of their household expenses. And then they really know what they're spending it on. And then make the adjustments, maybe in housing, maybe, you know, you're planning on moving to a lower cost state or a smaller home or, you know, however, and you would adjust then that housing cost down, right, to what it will actually be in retirement. And you add that all up. And in this case, you know, this example is $6,000 a month is what, you know, the retiree would be expecting to spend. If you annualize that, 72,000 a year, and then you're going to subtract out fixed income sources, right? Kind of like what Alex showed on the previous screen. You know, to the extent that you've got Social Security coming in, maybe you're a government annuitant and getting FERS pension coming in or other pension, you know, that's a really nice fixed income payment that you could subtract from the 72,000 that gets you, okay, I've got 50,000 a year that I need to have generated from my portfolio, my brokerage, my savings, basically, to date. And you can compare that to what your actual portfolio value is. And, you know, if you look at it in this year, you might want to just cry and look at it another day. But if you compare it and you say, oh, okay, you know, that's an annual distribution rate of 5%. You know, Alex noted the rule of thumb is 4%. Maybe that's okay. It really has to do with, you know, a lot of factors, of course, but is it achievable? Do you feel comfortable with it? What is your risk tolerance associated with it? But that at least gets you into the ballpark as to whether or not, you know, you think you might be ready to retire. Okay, next page, please. And that's Alex, back to you.
All right, so healthcare is, of course, a very large expense, and each year it continues to increase. I mean, we don't necessarily have the data going forward, but for 2022, it's actually $315,000, and that's throughout your retirement. Now, this number, by the way, does not include long-term care costs, which is something we'll discuss separately. Now, for many of our clients, I'll tell you, they either keep their existing coverage when they're, you know, retiring from federal government specifically, or some private firms, they actually cover a portion of their premiums and or payments. But for many, it's really a combination of different Medicare components. Part A, which is of course free. Part B, you know, the premium depends on your level of income, and then Part D premiums. Now, we're not going to go into this in much detail. We'll have a separate webinar next month, I believe, talking about Medicare in detail. Now, long-term care. this is one of those, I'm going to say, top 3 reasons of actually why people want to either develop or revisit their existing plan. Now, according to the Center for Retirement Research, Americans turning age 65 today have a 70% chance of needing some kind of long-term care service in their life. Now, that doesn't necessarily mean that you'll need it for a long time, but on average, women will need it for close to 4 years, and for men, it's a little more than 2 years. Now, the costs have been increasing over the past number of years. It's interesting, actually, for 2021, there were some reductions, which is a little surprising to me. But for an assisted living facility in Maryland, and I'll tell you, it's similar for Virginia, it's close to $60,000 per year. For nursing home care, for a semi-private room, you're looking at more than $120,000 per year. And for a private room, close to $150,000. Now, one thing I mentioned when we actually had meetings with our clients, these are averages. When you actually visit some of the facilities, in many cases, you'll notice, some of the major differences between them. And, perhaps you'd prefer something that has a higher cost. And of course, from our perspective, we do want to plan for that. In terms of the planning process, from our perspective, essentially it's a 2-step process. Step 1 is to assess and see how well you're prepared to self-insure, if that's even a possibility for you. If that's possible, I'll tell you, many people would not be comfortable with that anyway. They want to make sure that, again, a significant sum of their portfolio, essentially their investments, is directed to perhaps someone else, used for other reasons, not so much long-term care. So that usually leads to the policy decision. What type of policy do you need exactly? When should you apply? Should it happen now, or should you actually wait? So that is usually a big part of the planning process. Now, Social Security. Multiple strategies. Timing is important because, of course, your benefit is going to be very different depending on the age when you decide to collect your benefits. And again, we will cover this in some detail, but next month we'll also have a separate webinar, which is actually, I believe, our most popular webinar on Social Security, where Judy and I will dive into this in detail.
In January.
In January, I apologize. So, Medicare is next month and Social Security is in January. Right. So for most people who are not disabled, you're able to apply for your Social Security benefits anytime between your age 62 and age 70. And again, anytime. Now, there are some specific reasons of why you would want to apply at a certain age. Usually for planning purposes, we start with the assumption that our clients are going to begin collecting their benefits at their so-called full retirement age, or FRA. And in 2022, by the way, the maximum benefit is $3,345. For most people, their FRA is anywhere between age 66 and 67. It just happens to be optimal for most people. Doesn't necessarily mean for all people, all of our clients, certainly not for married couples. That's when we have separate strategies. Well, what are some of the reasons behind that? There's no longer any penalty if you continue to work. So, some people, at least, they want to collect their benefits. They want to work somewhere part-time, and essentially your Social Security benefits will not be reduced once you reach your full retirement age. Your life expectancy, which is actually one of the major assumptions you have to make when you're deciding on when to collect your benefits, essentially you don't have to make any assumptions. The assumption is that it's actually average in this case. Now, why would some people want to wait perhaps all the way to age 70 to collect a higher benefit? And in the year 2022, it's almost $4,200. Well, again, one of the reasons is for each year that you wait, your benefits automatically increase by 8%. Again, it's automatically increased by 8%, even if you no longer work. Now, perhaps you expect yourself to live longer than the average, which is age 85, by the way. Perhaps you have other sources of income, such as your pension, such as your earned income, again, and you just don't really need more cash. So why not defer it until a later age? Perhaps you prefer to invest conservatively. meaning your portfolio is expected to earn anywhere between 4 to 5% perhaps, and getting that additional 8% in Social Security benefits is attractive to you from that relative perspective. Now, why would you want to collect earlier, perhaps at 62 or 63? Well, perhaps you have some immediate cash needs. You're in retirement. You don't necessarily have no large portfolio in place. You don't want to deplete your own resources, so you decide to collect your benefits sooner. Now, one of the interesting facts here, when you actually look at someone's Social Security statement, in some cases, because it's based on your earnings record, you would notice that the benefit actually doesn't increase all that much. If you wait from 62, let's say, to 67, there's an increase, but it's not all that significant. So that's usually one of the reasons for that. And of course, if your life expectancy is shorter than average, that is usually one of the reasons why you would want to collect sooner. Now, planning for longevity risk in retirement is one of those, again, I'm going to say most important issues that we want to cover as part of the planning process. What are some of the solutions here? Well, of course, working longer is always, well, at least usually on the table. Many people don't necessarily prefer to do that. Adjusting your investment strategies. As I mentioned earlier, some people, they just have this assumption that they have to invest so conservatively, and as a result of that, they need to, continue saving. And actually, in some cases, that is not true. And I very much enjoy those meetings when someone comes to us and says, I have no idea exactly, when I'll be able to retire. And you tell them, well, look, even under our conservative assumptions, you should be able to do that in a few years. Timing your Social Security benefits will have a very significant impact, of course, in your cash flow. You need to make sure you're making the right decision. Making sure that you have enough fixed income in the form of, Social Security, pension, annuities, that portfolio buffer that I discussed earlier. And of course, thinking about your living, arrangements, specifically in the context of your long-term care needs. All of these things really need to be addressed as part of your planning process. Now, estate planning. So this is where, this is perhaps outside of what we're, want to discuss today. And there's a poll question coming your way. So let me actually pause for a moment so you can get a chance to address that question. Yeah, so estate planning. This is, again, outside of what we want to discuss in detail today, but no financial plan or no comprehensive financial plan is truly complete until you address your estate plan, of course. Now, what are some of the components that should be considered? Well, everyone needs to have a will in place. Now, do you need to have a trust, revocable, or perhaps even irrevocable, which is much less common? Do you need to have a power of attorney, durable, financial, health? What would happen? Who would be making decisions on your behalf if you become incapacitated, perhaps temporarily? That needs to be addressed. What about your beneficiary designations? Something that you can actually check tonight, especially if you have sizable tax deferred accounts, such as your IRA, such as your 401k, or your beneficiaries. Life insurance. This is important. Again, if you have a term life policy, just to make an example, with a sizable amount, exactly what would happen to it. Planning for charity, which is something that Judy will talk about separately. A lot of that is actually addressed as part of your financial/tax plan, but also part of your estate planning, and of course, overall tax planning. Now, this is again where we would help you coordinate, but usually, pretty much always, we would refer you to a qualified, very important, qualified estate planning attorney to address all these questions for you. Now, touching on the tax issues, and this is actually one of those common questions or perhaps even comments I get. It's like, well, Alex, I don't really have all that much. I shouldn't really be worried about that. Well, perhaps that's true. Perhaps that's true on the federal level. And again, what you're looking at here, this is a summary of lifetime tax, estate tax rates and exemptions in 2022. And then we make some comments about what would happen after the existing rules sunset or essentially expire in 2025. So again, on the federal level, it's more than 12 million for per individual. So for a married couple, it would actually be double of that. So perhaps you're fine in the federal level. What about the state level? In DC and Maryland, it's only 4.25 in DC and 5 million in Maryland. In some cases, actually relatively easy to hit that target. Let's say you have a house in Bethesda, maybe you have a rental somewhere, you have a portfolio in place, and over time it continues to grow, and you actually hit that number. Well, you don't want to be taxed, or you don't want your estate to be taxed on the amount above that. That is something you certainly want to discuss ahead of time. And of course, what's going to happen in 2025, assuming no additional legislation is introduced, that is another reason why you'd want to plan for that. In Virginia, by the way, there's no estate tax in place. Judy.
Okay, one more slide, Alex.
Yep.
Okay, all right. I wanted to cover the Secure Act and what is commonly called either the Son of Secure or the Secure Act 2, because it has a significant impact on retirees. The Secure Act is the setting every community up for retirement enhancement. And I have no idea how they came up with that name, but that's what it stands for. And it was passed back in 2019. This is the law that did really change how required minimum distributions are being treated for retirees. On the good side, the positive side, it lifted the age limit. So it used to be that if you were 70 and a half, you could no longer could contribute to an individual retirement account. The Secure Act lifted that limit. However, it's still subject to the earned income rules. So you have to have earned income in order to be able to make a contribution to an individual retirement account. So I did want to listen to that. So in the proposed Secure Act 2, there's no change, right? So it's already age limit lifted. The catch-up contributions is $1,000 for an IRA and $6,500 for a 401k and similar plans. Under the Secure Act 2, that would be indexed for inflation, the IRA amount, and the 401k amount actually is quite generous. It would go up to $10,000 catch up for participants age 62 to 64. And just as a qualification on that, the law is presently written, which has not passed, by the way. It is expected to pass in 2022 from what my reading was today. And hopefully the lame duck Congress and the Senate will take care of it before the end of the year. But the contributions would be made on an after-tax basis. In essence, it's called the Rothification. It would still allow you to make these catch-up contributions, but you wouldn't get a tax deduction for it. Instead, it would be treated as after-tax, and then the earnings on that portion of your contributions would be tax-free in the future. The required minimum distribution age in the regular Secure Act, it did increase it from 70 and a half years to 72. So that's the current law. And under the proposed law, it would actually be increased to age 75 gradually. Age 75 wouldn't occur until the year 2033. However, what I was looking at said age 73 could possibly be in next year in 2023. Now, because this Secure Act 2 has been kicked down the road now for several years, that may push back another year or so. But the idea is to, people are living longer, to allow people to not have to start taking the required minimum distributions till they're a little bit older. The penalties for failing to take an RMD are really draconian. They're terrible. It's a 50% tax right now if you don't take your required minimum distribution. And so the Secure Act 2 is saying, hey, we need to do something about this. It proposes to reduce the penalty to 25%. and if the mistake is corrected in a timely manner, to further reduce it to 10%. So we as tax preparers certainly are looking forward to that change coming into law. And the qualified charitable distribution rules, which I'll be explaining in another slide, but essentially the maximum that can be made as a qualified charitable distribution from an IRA is $100,000. And that would be indexed with inflation under the Secure Act 2, and would also allow a one-time up to $50,000 QCD to a split interest entity. Next slide, please. Okay. Also under the Secure Act, I mentioned it did, what they say, Congress giveth and Congress taketh away. Well, they giveth by allowing you to still make contributions to your IRA and to increase the age for the required minimum distribution. But to pay for that, they basically ended what was known as the stretch IRA. And the stretch IRA essentially is when a non-spousal beneficiary inherits an IRA, right? They used to be able to take that IRA over their life expectancy. And that was huge. If you were a young adult and you inherited an IRA, you had to take those distributions, but you could spread it over quite a long time. The Secure Act nixed that. No more stretch IRAs, basically saying that the inherited IRA has to be taken within 10 years. Okay, so everybody was thinking, well, should I take it now? Should I take it in year 10? How should I take it? Well, the IRS earlier this year came out with a proposed regulation saying, hey, you can't just wait till year 10 to empty the bucket. You have to start taking it, each year. And that was out for public reaction. And just last week, actually, the IRS issued Notice 2022-53. It is issuing final regulations. This is going to be what's required. They're going to say that inherited IRAs, you must take a minimum distribution each year for years 1 through 9, and then the balance in year 10. So they're not going to allow you just to wait until year 10 and take it all at one time. So keep a lookout for that. Because it is already, November of 2022, the notice said that they're not going to penalize non-compliance with this for 2022, but they will starting in 2023. Which, of course, as I say, the whole result of the no stretch IRAs is to, accelerate the tax, right? Is to have the non-spousal beneficiaries take the IRAs into income and pay tax. And that is essentially how Congress is saying it's paying for having to delay in the required minimum distribution from 70.5 to 72, and then also allowing retirees to continue to contribute to their IRA accounts. So one solution is IRA owners can convert. They can convert their traditional IRAs into Roths. And Roths are inherited tax-free. There's no required minimum distributions to them. Couple things to keep in mind here. The tax rates will sunset at the end of 2025. That's the current income tax rates passed by the Tax Cuts and Jobs Act of 2017. And under current law, they will sunset. So tax rates will be higher starting in 2026. Keep that in mind. And also with the market down right now, it's kind of a special opportunity for many taxpayers to think about making a Roth conversion. That is taking that IRA into income, paying the tax at the lower tax rate than will be in effect in 2026, which is ouch. Nobody likes to accelerate tax. But what's going to happen is that's going to be now in the Roth account, and if and when the market basically appreciates, that appreciation will be inside the Roth. So we're doing a lot of Roth conversions with clients. We have been all year long. It's one of the lemonades from lemons, so to speak, in this market that we've had in 2022. Next slide, please. Okay, so tax planning strategies. Tax bracket management, I'm going to talk about in the next slide. Health savings accounts, we haven't mentioned those before, but if you happen to be working and participating with an employer that has a high deductible health insurance plan and offers a health savings account option, strongly consider it. It's essentially works like an IRA, but the monies can only be used for qualified medical expenses. It's portable, it can be invested. If you have the cash flow, you cannot use it for medical expenses right now and let it grow so that when you are in retirement, it's another bucket, so to speak, of a source of funds that you could use to pull out to meet your rising healthcare costs. So definitely maximize the health savings accounts, and you get a tax deduction for it at the time that you do. Investing tax efficiently. Certainly that's important to determine, whether or not and where your investments are sitting at in terms of the retirement account or your brokerage account, because they're taxed differently when they're withdrawn. Qualified charitable distributions we'll talk about in a second, and same with the donor advised funds. We talked about the Roth and traditional IRAs. And the standard deduction, I just wanted to mention there, many seniors really can't take advantage of itemizing anymore because when the Tax Cuts and Jobs Act came into play, it essentially suspended the personal exemption, and it capped the state and local income tax deduction at $10,000. So if you're married filing jointly and your standard deduction age 65 is $28,700, and you've maybe paid $10,000 in taxes, be it real estate tax or income tax, that leaves you, $18,700 in kind of other unused free exemption deductions, if you think about it. So many taxpayers will in fact use the standard deduction as opposed to itemizing. And what this does is it allows the opportunity to do what's called bunching of deductions, where you take all of your, primarily it's charitable contributions, maybe it's medical costs, but you bunch them in 1 year that you're going to be able to itemize and get that benefit. And then, you revert back to the standard deductions in other years. Next slide, please. Oh, we're running out of time. The tax bracket game, I'll just go over quickly, but this explains that not all items of tax are taxed at the same rate. So, retirement distributions from IRAs and 401k accounts, and retirement accounts, qualified retirement accounts, they're taxed at ordinary income rates. But investment income, interest, dividends, long-term capital gains, they're taxed differently. They're taxed more favorably. And in this example, if you're married filing joint and you're in that 12% tax bracket, which goes between $20,550 and $83,550, you're going to pay 12% on your ordinary income, but zero. See on the far right column, zero on long-term capital gains and dividends. So that's something that that we definitely work with clients on to try to achieve tax savings there. And next slide. The qualified charitable distribution, this is beautiful. This is really wonderful. This is the ability to take a required minimum distribution from your IRA and make it a distribution directly to a qualified charity. And it can't come to you, can't send you a check and then you, deposit it in your account and write a check to the charity. But if it goes directly from your IRA custodian to the charity, it reduces dollar for dollar the amount of the required minimum distribution that's taxed at ordinary income rates on your return. Just did a tax projection for a client, and $75,000 QCD is going to save them $4,000 in tax to do it that way versus to itemize. And so, it's 4,000 is 4,000. So it's definitely worth looking into that. And then a donor advised fund is essentially, it's like a holding fund where if you want to accelerate your deductions, like bunching, like we just discussed, for charitable giving, and you want to do it all in 1 year and get that tax deduction all in 1 year, perhaps to offset, a Roth conversion. Maybe you want to do a Roth conversion and you don't want to pay, that high rate of tax, so you're going to do a contribution to a donor advised fund to offset that tax and get you into a lower tax bracket. Then what happens is that donor advised fund, which is really under, your, I won't say it's under your control, but it's under your advisement, and it can grow, it can be invested. And then you can tell it, hey, I want you to contribute, 10,000 to this charity next year and 5,000 to that. You can kind of give it the power of appointment, so to speak, in the future and still meet maybe your charitable giving goals. But what you're doing is accelerating that charitable gift into the year that you need that tax deduction, and then, doling out those charitable gifts over time in the future. So it's really quite a brilliant tax planning strategy. And gosh, it's 6 o'clock. I'm sorry. Next slide. I will just really quickly summarize here. Consider where your residence is for retirement. Remember, we said 35% of your budget is going to be housing. So there are, states. Mississippi is the lowest cost. Hawaii is the highest cost. Anywhere in the Midwest seems to be kind of, more moderate cost. But consider your state of residence, not just for income tax, but for housing costs and the state and gift tax. That's going to be a big driver in your ability to afford your retirement. And with that, gosh, I certainly understand if you need to leave at 6 o'clock, but Alex and I will stay on and entertain a few more questions. I really apologize. Usually it's just a lot of material to go through.
There's a lot of information. Yeah, there's a lot of material.
Yeah. But we are having our upcoming seminars. December 15th is the Medicare. January 10th is the Social Security. It's going to be Alex and myself again. And then in December, there are various different dates to choose the year in tax planning and market update webinar. With that, Alex, you want to just cover a couple questions?
In terms of the questions, yes, just to make it fair. So we have more than 40 questions actually that came to us prior to the webinar. And I see there are actually several in the chat box. And again, please ask your questions. We'll read your question out loud. We'll not mention your name for privacy purposes. So we'll do one that was submitted to us prior, and then we'll do one from the chat box, just to keep it fair. All right, so here's one question. At what point should Roth IRAs or IRAs be considered instead of traditional IRAs and 401ks? So what do you think about this one, Judy?
Oh, okay. So this is a good one. And actually, we get this a lot. It has to do with a couple of things. Obviously, your age is a key factor, because the longer that you have funds in a Roth that can be invested and compounded all tax-free, that's just a tremendous nest egg for young adults to be able to have. So age is a key factor. Tax bracket that you're in now and tax bracket that you expect to be in retirement. Most people probably expect their tax rate to be lower in retirement than in their key earning years. So I would say you want to take that both of those into consideration. Typically, you don't want to donate, you do not want to put money into a Roth when you're in a high income tax bracket now. But I will just qualify that and say, consider the diversification. It's not all or nothing. Maybe you do half-half. I mean, maybe you hedge it. You put some into the Roth and the bulk of it into a regular 401k. So you can actually generally have some ability to make that choice.
Sounds good. That was a very complete answer, so I don't have much to add to that. So a couple of, I guess, quick questions and answers from the chat box. If you're 65 plus, can you still use catch-up contributions of 6,500? The answer to that question is positive. You can continue contributing into your, I believe the question is about your 401k account for as long as you're working and you have, of course, enough earned income to do so. And by the way, the same applies to your IRA account, which is a new rule as part of the Secure Act. You can keep contributing into your IRA account, traditional or Roth, depending on which one you qualify for, including your spouse, if you're filing a joint tax return, as long as at least one of you has enough income to make those contributions. Next quick question here, and unless you want to add anything, Judy.
No, that's fine.
Who qualifies to convert the IRA into a Roth IRA? Quick question, Judy.
Who qualifies to convert? To it. I'm sorry, into a Roth IRA?
Yes.
Well, so the best time to convert to a Roth is in a low tax year. So a lot of times retirees will retire. They're not at the 72 age yet to have to take the required minimum distributions. So between the time that they retire and they no longer have those tax wages and the time that they actually start taking the RMDs, they may actually be in low tax years. That would be the opportune time to do a conversion, so you're taxing in a lower rate. But the other opportune time is right now with the market down, right? Because even if you were to pay a slightly higher tax, the fact that you are already, if the market's down, 18%, 15%, and that growth then occurs inside of the Roth later, well, that more than offsets the fact that you maybe have paid a little bit higher income tax. And as I mentioned, if you have the Roth conversion, consider doing the donor advised fund or other charitable giving or other tax planning options to offset that tax, particularly if it pushes you into a higher tax bracket. You may be able to offset it enough to have a tax, say, at the 22, 24% bracket instead of 30 or higher.
Sounds good. Not a complete answer. So to change gears a little bit, I'm interested in hearing about the prospects for recovery of the stock market, something that, of course, we didn't touch on today, but again, we talk about at least quarterly in our quarterly market updates. So I'll say two things, well, I guess three things. No crystal ball here, but the markets actually have been recovering quite nicely over the past 45 days or so, or should I say 47 days at this point. The markets are up by more than 10 percentage points. Now, it is not clear how sustainable this recovery is going to be. And from our perspective, there are two factors that we're paying close attention to. Of course, in practice, there's 22, if not more. We're looking for inflation, declining. We're looking for that trend. It doesn't necessarily mean that it's going to go from 7.7% where we are today to 7% next month, but we need to see that gradual decline. And if that's the case, perhaps the Federal Reserve Bank or the Fed will, decide to continue increasing interest rates to fight inflation, but not at the same rate. Perhaps the next rate hike is not going to be as significant. If that's the case, again, there's a high possibility or high probability of the markets recovering, because if you look at it, and I'm going to again make a very brief comment, the rest of the markets are actually quite healthy, and the economy overall is quite healthy as of today. So maybe two more questions. What do you think, Judy? Two more questions?
Well, I think actually we're already over.
Okay.
Yeah, but I will just say, you have our email addresses here on this slide, and you have our websites there, and of course our phone numbers. So feel free to to reach out to us with questions that you might still have. We're happy to assist. Anything else to add, Alex?
Well, that's all. Yeah, I know, again, there's a lot of questions. So yes, feel free to reach out. We'll be happy to address them for you. And as always, thanks for participating in our webinars. We'll really try our best to educate and, again, answer as many questions as possible.
And have a happy Thanksgiving, everybody.
Yes.
Hopefully we'll see you at our December webinar. Take care. Good night.
Thanksgiving. Bye-bye.